Hello bro and welcome back. I'm glad to see you again because today we have very exciting stock to analyze. Today we are going to analyze the stock that has the biggest stock split in the history of Wall Street whatsoever, and this stock is called Chipotle Mexican Grill Incorporated with the stock ticker CMG. So let's begin, okay? Now, as always, we are going to analyze Chipotle using this little Canva presentation that I prepared right now here. And first of all, bro, you are asking yourself, why should you listen to me anyway? Because my name is Yasha, bro, and I am your best investment advisor who will help you make smart decisions, okay? Now, this is me right now here. And additionally, I also know quite a few strategies that will help you outperform the SP 500. So click the first link if you are interested in that, okay? Now, let's begin with the analysis, okay? So this is going to be very simple, straightforward, beginner-friendly analysis, without any bullshit, without any shit whatsoever, because I don't want to be like your useless professor on business university who just talks useless garbage and doesn't teach you anything whatsoever about the stocks, okay? Now let's begin. So as a complete beginner, bro, you generally have to care about only following 6 things: chart, profit, debt, money on the bank account, value, and price. Now let's begin with the chart. So for chart, we have here a little instruction that tells us chart has to grow for all 10 years. Now, what exactly does that mean? That means that I will here draw a little exponential line, kinda like this, and then we will compare the actual stock chart, so this orange one, with the black one, so with that exponential growth, okay? Because we want to see that the chart grows exponentially, because that means that the stock is very healthy, that it's growing through the years. So this is what we want to see, okay? Now, obviously, here you can compare the stock price, the orange line, with the black line, and you can see that the actual stock price actually follows this line, kind of like this. So this is very good sign, bro. The stock is growing exponentially. This is what we want to see. Let's go, okay? Now we come to the profit. And for profit, we also have a little instruction that tells us profit has to be in plus and it has to grow. Now, the very same story as with the chart. First, I will draw a little exponential line. I don't know what's with my mouse at the moment. So yeah, kind of like this. And now we will compare the profit with that line. And you can see that the profit literally follows that line perfectly. Obviously, in 2014 and 15, something happened, like they had a massive plus, and then in 16, almost nothing. But since 2016, the chart grows exponentially. They have exponential profit. So that's absolutely amazing to see as well. The profits are growing. This is what we want to see, okay? Now we come to the debt, and in terms of the debt, they unfortunately do not disclose how much debt they have, so I decided that I will use total liabilities as well, okay? I mean instead, because total liabilities are actually literally all of the costs that the company has, whereas debt is only a portion of those total liabilities, okay? So if we analyze total liabilities, that actually means that we are including debt plus other costs in our analysis, okay? Now, the general instruction is that the debt, or in our case, total liabilities, have to be low, plus preferably they want to be decreasing through the years, okay? Now, the perfect chart would look kind of like this. But we can see right now here in this case that the total liabilities are growing massively, especially since 2019. So here probably the company started investing a lot more money inside. That's why the debt is growing. So we don't want to see the debt grow. So this is a bad sign for us. But if this debt means reinvestments into the company, then that's actually a good debt, okay? So, but just for the sake of the instruction, we don't want to see debt growing. We want to see profits growing. So we mark this as a bad sign, okay? Now we come to the money, and for the money, we actually mean money on their bank account, literally on the bank account, okay? And generally also we want to obviously see more money than costs on the bank account, and also generally in the company. So how do we know if they have more money than costs? It's quite simple, bro. Use your brain. They have plus $1.3 billion on their bank account. So they obviously have more money than the costs. Otherwise, they wouldn't have this little plus here, okay? So this means that they are good to go. They have money. They can cover some quick costs if they have some. They can cover some potential swings in the markets, you know, going up and down in the market. They can cover all of that. They can cover unexpected costs. This is what we want. This is very good to see, okay? Now we come to the value, and in terms of the value, we want to buy stocks that are undervalued, okay? Now, how do we measure if the stock is undervalued or not? Quite simple, bro. We use two metrics for that. The first one is so-called P/E ratio, and the second one is intrinsic value. Now, as a complete beginner, this might be a bit complicated. Don't worry, I plan to make a video about all of the complicated things that I'm explaining in my analyses. But as a complete beginner, bro, you should only care about P/E being lower than 15 and intrinsic value being higher than the current stock price, okay? Now, you can see that the P/E ratio of Chipotle at this exact moment is around 70, which is much higher than 15, what we want to see. It's around 4 times higher. So obviously, in terms of the P/E ratio, the price is overvalued, okay? I mean, the stock is overvalued. Now, let's come to the intrinsic value, and here I want to have your fullest attention, bro, because this might be quite a complicated concept for a beginner investor, okay? Now, intrinsic value actually tells us what should be the fair price of this stock at exactly this moment, based on some calculations about cash flow, about, I don't know, income statement, about balance sheet, about basically all of the financials of the company. Based on those financials, the current price should be $1,630, but the current price is actually $65. So it's much lower than the price than the company should have at the moment. Do you know what I mean? So basically, the intrinsic value tells us what price should the stock have right now, and then the price tells us the actual price. It's quite logical, okay? Now, you might be a bit surprised at the moment, why is intrinsic value fucking 100 times maybe, or I don't know how many times higher than the current price. Why is intrinsic value 1,600 whereas the current price is only 60? The reason for that is, in my opinion, because of the stock split, okay? So basically, stock split is something that happens on the stock market not so often, to be honest. Basically, they split the stock. It's that simple. So if you had maybe 100 shares before the stock split, and then they split each stock in 2 parts, you have basically 200 shares, okay? And here is the same. And I think that this is still the old calculation, because I was researching the internet, and this is the old calculation, this is the old intrinsic value of this company, because the analysts, they still didn't adapt the intrinsic value to the current price, okay? So we will mark that also as a sell, just to be sure, okay? Obviously, if this is a bad sign in our analysis, but in reality a good sign, then that's even better, okay? And now we come to the price. And for price, we have a little simple instruction that tells us price has to be lower than 150 euros or dollars or British pounds, okay? Because we don't want to buy stocks that are overpriced. And I think the 150 euros is quite a good border between the underpriced stock and the overpriced stock. So if the stock is below 150 or at least somewhere around 150, then that's still a good sign, okay? And this stock at the moment when I was doing the presentation, it was around $65, almost $66. So that's a good thing to go as well, okay? And with that being said, we come to the final presentation, bro, where we are just going to summarize basically everything that we found out about this stock and then decide whether we should buy or sell it, okay? Now, in terms of the chart, bro, if you revert a few minutes into the past and you can see the chart, you can see that it actually follows that exponential line that we draw. So chart is a good thing. Now we come to the profit, and profit also follows that exponential line. So profit is also good to go. Now the debt is unfortunately not disclosed, so we analyzed total liabilities instead, but still they were also growing through the years, which is what we don't want to see. in terms of the money on the bank account, they have $1.3 billion. So that's an amazing sign to see because they can cover some unexpected costs. In terms of the value, the stock is overvalued because P/E ratio is higher than 70 and also intrinsic value is a bit absurdly high, so we don't know exactly what it is at the moment. And in terms of the price, the stock is around $70 or 65, I think, at the moment of making this. So in terms of the price, the stock is okay. I don't know what the fuck is with my mouse, bro, so sorry for that. Now, the final evaluation, bro, obviously we can buy the stock. It's very good stock, bro, because the company seems to be growing. They have amazing financials. I can show you here the summary. You can see total revenue grows, gross profit grows, margins are okay, net income grows, operating income grows. Like, it's absolutely amazing growth, bro. And then additionally, they are reinvesting a lot of money back into the company. They have positive bank account. The only bad things that I can see are very high debt, because we can see literally the how are they called, the liabilities, they are growing, and we don't want to see that. And additionally, high debt is not disclosed, so we don't know what actually is the debt. And additionally, bro, the stock is overvalued in terms of the P/E ratio and maybe also in terms of the intrinsic value. And for me personally, the worst thing is that this is a very good company, but they don't pay dividends. So if you are a dividend investor, bro, this company is absolutely useless for you. Now, if you want to know more about stock market investing, bro, click the first link in the description. Also subscribe if you want to know more about some analyses. Drop the comment, what do you want to see in the future. I'm here to help you, bro. I'm here to teach you about stock market because your professors didn't do that at all. And join me on this journey, bro. Do the hard work and see you on top of the world.